best video. I got a little lap baby with me. What's up, buddy? You just woke up. So it's just gonna be a quick video for new and developing traders. A little strategy, or the way I approach the market. I'm not even gonna call it a strategy. And like I said in previous videos, past performance is not indicative of future performance. So what I like to do is I like to approach the market from usually look at a 4-hour chart, break down to the 1-hour chart, and look at the 15-minute chart and go from there, right? I like to base my entries off of the 15-minute chart. I feel like if you're a new trader, you're just coming into trading within the last 3, 4, 5, 6 months. Some mentors and people are going to tell you, oh, trade a 1-minute chart, trade a 2-minute chart, trade a 5-minute chart, whatever. I say the cleanest setups to me happen on the 15-minute chart, okay? It's easier for me to pick a bias for the next 2 to 3 hours of the session. I like to use 15-minute fair value gaps and the mitigation of those fair value gaps to decide on what price is going to do next. I like to use cumulative delta volume. What is it? Cumulative volume delta. What is it called? CVD. Cumulative volume delta. Right here at the bottom to also determine my entry points. Right. So we're gonna start on a 15-minute chart right here on the Nasdaq, and right in pre-market here at 9 o'clock. Slide this over some more so you can kind of see it on this chart. Pre-market here at 9 o'clock. And this is a 2-minute chart on this side, 15-minute on this chart. So we had a 9 a.m. 15-minute fair value gap, right? But the 9:15 candle is a doji star candle, right? Now you could have entered off of that 15-minute fair value gap. And the reason why I say you could have entered off of it is because when you go back and look at the cumulative delta volume right here, this candle, the volume to the downside pretty much engulfed almost 4 candles, right? So that's kind of usually a good indication that price is going to continue that direction. Doesn't mean immediately, but it's a good idea on what price is going to do over the next couple minutes. So what we do is, let's say we entered on that 15-minute fair value gap. All right, price pushed down 47 ticks before it pushed up 200 ticks. All right, now this type of strategy, a higher time frame strategy, which 15 minutes isn't necessarily high time frame, but it's a higher time frame than the 1, 5, whatever, right? You want to trade with smaller size, okay? And the reason why is because you're looking for larger swings. So the larger swing can make up for you trading with bigger size, but also it allows you to stay in the trade long enough for the trade to develop. So let's say you were trading 2 MEQs, price would have pushed back on you $200 if you had entered on that 15-minute fair value gap based off the fair value gap, based off the cumulative volume delta, right? And also based off the fact that the stochastic here was oversold quite significantly, as you can see. It was overbought, and it was a stochastic cross right before that 15-minute fair value gap. And that usually is an indication that we have a roof, a ceiling that we can place our stop loss up above. So you could have held that trade, could have got in there, pushed on you 200 ticks. You could have held it, for about 2 hours, and you could have got 500-600 ticks off that trade, right? So 2 MEQs, $500-600, okay? $200 worth of drawdown. It's not bad risk to reward. It's a 1 to 2. I mean, it was like a 1 to 3, really. Could have got like a 1 to 3 easily before the next major pullback. So, and like I said, you could have cut off one and let her run, but even at the next lowest point here, there was R at, it was still a 1 to 1.7 trade. So I think it's a good trade. It's trades that I usually take quite frequently because I'm more of an intraday swing trader than I am, just a high frequency scalper. So I usually tend to catch 200, 300, 400, 500 tick trades quite often with smaller size. But the reason I say approach the market this way is because if you learn to time the market on a higher time frame, okay, you have less to look at, less to confuse you. The entries are usually cleaner, okay, and once you develop the ability to consistently get 200 tick trades, 300 tick trades, 500, 600 tick trades, as you grow your account or as you buy bigger prop firm accounts, it allows you now to make more money because you can scale up your contracts if you have the available drawdown, and you can make way more money, right? So if I was trading 2 NQs right there, that could have been $6,000 a day, just over 2 NQ contracts, right? And your drawdown would have been about $2,000. So 150K prop firm account, that's nothing. It's literally nothing. You got $7,500 worth of drawdown on one of those accounts. So you could take a trade like this on a 15-minute 3 times before you blow the account. So I would like to encourage you to try trading higher time frame, catching larger swings, believing that you're set up on the 15-minute chart is going to give you 200 ticks a day, and taking off some of the profit and letting the rest run. And I think over a long period of time, it'll make you an extremely profitable trader. That's it for today, guys. Quick little video. Stay holy.